There is a fatal flaw in how most people manage their wealth. When the stock of a famous household name company crashes, the financial echo chamber goes into overdrive. Social media influencers pump the narrative that it is a once-in-a-lifetime discount. The retail investor hears this algorithmic noise, looks at the bleeding chart, and automatically assumes it must be a buying opportunity. We call this the retail dislocation. Assuming a massive price drop equals a discount is a trap based purely on emotion and manufactured hype. Over time, buying assets without a rigid, rules-based framework bleeds your capital allocation dry. Institutional architects do not buy the dip. We do not listen to the noise. We execute a mechanical protocol. Every single asset must survive a ruthless screening machine to remove human emotion entirely. In this video, I am going to show you exactly how our system surgically rejects a classic retail trap and mechanically accepts a disciplined, tactical growth play. Because when you are engineering your capital, process must always dictate precision. System over emotion. Let's run the audit. We categorize first. Our entire architecture is strictly divided into 6 distinct segments. Each segment is engineered with its own unique investment time horizon and a specific operational trigger. Before a stock is fundamentally analyzed, it must prove it belongs in one of these exact segments. Does its timeline align with the segment's strict horizon? Does its behavior serve the precise role we need for the overall portfolio? If an asset cannot clearly define its timeline and its purpose within our structure, the screening stops immediately. We do not force a stock to fit just because the price dropped. It is ruthlessly discarded, and we move on. Phase 2 is the fundamental autopsy. Let's run a classic trap through the machine. Nike. While financial social media relentlessly pumps the stock as a historic discount, our system silences the noise. We do not read headlines. We parse the complete financial reports and extract the exact management guidance from the earnings call to scan for structural integrity. And when we feed Nike's real data into the machine, it hits immediate, fatal triggers. First, our execution matrix demands proof of clean inventory clearing. Nike failed. The balance sheet exposes a massive, stagnant $7.5 billion of inventory. Furthermore, deep in the earnings call, management confirmed they are actively cutting future wholesale sell-in. The core operational engine is choking, but the retail investor reading Twitter doesn't see it. But the ultimate trap is the artificial margin illusion. Mainstream headlines touted a massive gross margin expansion. Amateurs buy that headline. Our system flags it as a one-time accounting benefit tied to tariff recoveries. Stripping out that illusion, the real underlying gross margin actually compressed to 40.2%. Because Nike possesses fundamental rot, it is ruthlessly rejected and blocked from our architecture. The system just saved you from catching a falling knife. Now we run Palantir through the exact same fundamental machine. We strip away the retail AI hype and the emotional narratives, diving straight into the Q1 SEC filings and earnings call transcripts. We do not use hope. We demand hard, quantifiable evidence of operational execution. Unlike the accounting illusions we saw previously, Palantir passes the systemic autopsy. The data reveals structural revenue growth and genuine margin expansion. But because we are engineering a long-term position, the asset must prove it possesses the durability for our core segment, a segment built for low-attention, multi-year compounding. The fundamental strength we extracted confirms it has the structural moat required for this long-term allocation. The asset is cleanly assigned to the core segment. But here is the ultimate test of the system. Passing the fundamental screen is only phase 1. The amateur sees a fundamentally strong company and buys immediately, chasing the green candles in fear of missing out. The architect does not. We secure the asset in its segment, and we wait. This brings us to the final phase, the macro compass and tactical execution. A fundamentally exceptional company bought at the wrong time is a poor allocation. We do not chase green candles. Instead, we deploy a dual-metric macro compass, the Volatility Index and the Fear and Greed Index. We wait patiently for the data to align. We wait for market volatility to spike, and for the Fear and Greed Index to mathematically quantify the panic of the retail crowd. In moments of extreme fear, arbitrary support levels break. We do not rely on them. We rely strictly on our RSI targets and macro extremes. We let the broader market draw the asset down. Only then do we move. But we do not deploy all our capital at once. We execute tranche 1. We buy in calculated fractions. Why? Because if the market bleeds further, we are not trapped. We are prepared. The system is engineered to deploy the next tranche at the next mechanical threshold, averaging our costs down surgically. No emotion. No FOMO. That is how you stop gambling with your capital and start engineering a portfolio. System over emotion. The retail crowd is out there right now, reacting to headlines and gambling their capital on emotion. Architects are quietly building. If you are ready to stop guessing and start engineering your wealth, you need a protocol. Click the link in the description to download the exact 6-segment portfolio architecture we use to manage risk. Subscribe to the channel to align with our execution framework. Stop reacting. Start engineering. System over emotion. I will see you in the next audit.